It's the end of the year and it's time to be thinking about rebalancing your portfolio. After several good years in the market, rebalancing is more important than ever to help you manage and control risk and keep your portfolio in alignment with your long-term goals. On today's show, we're going to talk about everything having to do with rebalancing, why to do it, when to do it, how to do it, and the tax implications of doing it. I'm Brad Lineberger, Certified Financial Planner.
And I'm Matt Callahan, Certified Financial Planner. And this is Navigating Retirement. Let's dive in.
All right, Matt, we're talking about rebalancing today. Hey, tell the audience, what is rebalancing and why is it so important?
Yeah, it's a great question. And a lot of people think that it's a trivial thing or it's not very important. But at its basic level, let's just take a portfolio that you're targeting 60% stock and 40% bonds. And a year like this, maybe your stock portfolio ended up being 70% of the portfolio of stock, and then 30% ended up being bonds.
Because it's done well.
Right. So your stock portion of the portfolio has increased, but that's introducing new risk to the portfolio. So the idea behind rebalancing is taking some of your winnings off of the portfolio. So trimming the winner, in this case stocks, to go purchase the loser, bonds. So now reducing back down to 60% stock and 40% bonds.
So everybody knows that they need to do this. And in my experience, nobody's doing this, at least on their own.
And it makes sense for some people not to, because they take the greed into account. So I heard this thing before, fear buy, greed sell, or the opposite of like that, and repeat until broke. And so people see their portfolios just increasing over time, and they don't want to sell that. They want to keep the
ride
winnings
the
going.
wave, right? Because it's that emotional thing. So we all know that we need to buy low and sell high, but without a disciplined approach to doing this, to your point, nobody's doing it, and they're hanging on to their winners for too long, and then when the sector or the asset class goes down, their portfolio gets hammered. And we see it. We saw it with the tech wreck from 2000 to 2002. We saw it with the mortgage meltdown in 2008. We've seen it with other asset classes, and arguably we've had a melt up the last 5 years with the AI revolution. My thought is that could be the next place where if people aren't careful, they could get hammered if the AI shoe drops.
We're already seeing a couple of days that the market's just being crushed or hit pretty hard because of these AI stocks. So something to be aware of. And I mean, the behavioral aspect of the portfolio, that's a big aspect. So a lot of people that are doing it for themselves, they don't necessarily, or they can't control that part of it. So it may make sense to work with someone to delegate the emotional side of it.
Well, what's crazy, absolutely. And what's crazy, you were talking about the AI shoe dropping. The guy, the Big Short guy, he made the call, or I think he made it public. What's his name?
Michael Burry.
Yes. He made it public that he's shorting Palantir and NVIDIA. Is that what it was?
Yeah, both of those for a total of about $1 billion.
Palantir was down 19% after the announcement. Right.
Yeah, he's making some substantial dollars for his clients. But I mean, they forget of how often he's gotten it wrong. I mean, he's gotten it right a couple times in big ways. But I mean, this is market timing and market timing strategies that don't always work.
But it speaks to, there's so many people out there who, to your point, have not rebalanced. And so now as AI and tech is making up too large of most people's portfolios, now if and when the AI shoe drops and that sector goes down, people's portfolios are going to have outsized losses. And that really could have been avoided had people been rebalancing with discipline over all these years.
And so with rebalancing, then what is the right timing to do it?
Oh man, okay, I get asked that question all the time. So for the DIYer, and there's been phenomenal studies, do you do it monthly? Do you do it quarterly? Do you do it annually? And just to be clear, rebalancing is the disciplined process of selling things that you have too much of because they've done well, and putting those proceeds into the things that you don't have enough of. So it's not completely selling out of any one asset class to leave it and get into another. It's just trimming. I look at it like mowing the lawn or trimming the hedge. It's just keeping your yard looking clean, okay? So the studies out there are very clear that monthly is too frequently, and arguably quarterly is probably too frequently. So for the DIYer on an annual basis, and I say put a date in the calendar, end of the year. I like to do it at the end of the year, maybe the beginning of the year. So if you're doing this on your own, once a year is adequate, okay? But for the real answer is you should do it on an as needed basis because, and that's going to require some software. It's going to require some technology to do that. But when your large cap growth position let's say it was supposed to be at 20%. If it's now sitting at 23, 24%, that's the time to trim.
And then just for the audience, some of the large growth companies that you probably have in your portfolio, the Amazon, Netflix, Google's, Facebook, so all the big names that you have.
They've been crushing it.
Yeah, so I'm assuming that portion of your portfolio, hopefully it's not the whole portfolio, but has done really well this year. And I mean, we need to make some adjustments.
Absolutely. And not just this year, over the last 5 to 10 years, we've just kind of had a melt up in that sector. So the real answer is as needed. But I think if you're doing this on your own, I think once a year would do the job. And so you're just going to assess what's my allocation now. So get out the calculator or pencil and paper works too. But how much am I supposed to have in my U.S. large cap position, my U.S. small, my U.S. mid, international large, international small, emerging markets, real estate, and then look at your debt, your fixed income. How much am I supposed to have versus how much do I have? And the things that you have too much of, once a year, you're going to trim.
I was actually, you mentioned something that most people that are doing it on their own aren't doing the rebalancing, but I was just meeting with some clients the other day and looking at, not clients, they were prospects. They were coming in to show me their investments. And I was just asking them, basic questions of what the original rebalancing strategy was that their previous advisor was providing. And they said that even the advisor wasn't rebalancing their portfolio. So more often than not, that people, professionals and or individuals doing it on their own aren't rebalancing. And I think that's crazy. You need to know and do that because Vanguard, we looked at a study that Vanguard did. And they're the most do-it-yourselfer, low-cost investments. And they did a study that just rebalancing alone adds 0.14% to your overall return year after year. I mean, this compounds over time.
And I've seen studies that show that number much higher, not coming from Vanguard, but other institutions, that it's actually even more beneficial to rebalance.
But I like the point you made too of just too frequently of rebalancing, it can actually reduce those returns. So, I mean, there's a fine line, and the do-it-yourselfer, or if you want help discussing it, once a year, but you need to pick a date on the calendar and have a hard line in the sand just to do it.
Well, and what's crazy, and I think there's some practical lessons that can be learned from this year and the past few years. If you go back to March 9th of 2009, when the S&P bottomed coming out of in the Great Recession, it's been on a tear for the last 16 years. And most people I see coming in here, they have just let that ride. And so now their U.S. large position is way too much of the portfolio. And in fact, over the last few years, we've had people go, hey, we're going to, the international investments have been doing okay. But relative to the S&P, it's been the hottest game in town. I have heard so many people last year saying, we're going to sell the international investments and ditch them because they're not doing good. And let's load up on the S&P. Let's load up on tech.
And what a huge mistake this would have been, right? I mean, I've been seeing emerging markets up 30%, small international companies up 28 plus, and then international large companies up 26 plus. But I mean, these are incredible numbers. And like you said, not to say that U.S. markets aren't doing well this year either, but we don't know when they're going to flip flop. And it's nice to just be able to be rewarded for the patience that's been going on.
Absolutely. So if you were properly doing your rebalancing each year that the S&P's been red hot over the last decade, you've been selling maybe 1%, 2%, 3% of that piece of the portfolio, and you'd be redeploying into international small, emerging markets, international developed. And this year it really pays off. And I think that it gets overlooked a lot.
Absolutely. And I like that with that strategy too. You're taking the guesswork out of it. I mean, you're building the portfolio really to accomplish short-term, mid-term, and long-term goals.
Oh, you bring up such a good point. You can just see the anxiety when I talk to people doing this on their own. And they're sort of looking, they want you to have a crystal ball, which
we lost yesterday.
Yeah, mine broke years ago. They want you to have a crystal ball because I think they don't have a disciplined approach, and they're just working on guesswork and writing the trends, and they want to kind of forecast and predict.
Always chasing the next shiny object.
Right. And so a good system of rebalancing takes that guesswork out. And to me, it creates a lot more peace of mind. And when we look at the last 10 years, a good balanced portfolio has been right in the middle. It's kind of like that golfer, the old golfer that just hits it straight down the fairway.
I'm jealous of those guys.
Me too. It's not me. But that's what good rebalancing can create for you. So let's talk about the mechanics, because there's some people out there investing in mutual funds, some have ETFs, some are still using individual stocks. So let's talk about how does somebody do rebalancing correctly?
Yeah, great question. With individual stocks, I mean, obviously it is possible. I think it gets to become a lot more of a full-time job or even a chore, because to rebalance individual stocks can take a lot. And with ETFs and mutual funds, I mean, the main difference there is that the exchange traded funds are trading throughout the day. So maybe there's some benefit there when you're rebalancing your portfolio to take advantage of the quickness of the market movements.
Right.
But I mean, basket of securities of different areas of the market, similar to your mutual funds.
Right. So, diving in a little bit, my preference, I would recommend using ETFs, exchange traded funds, or direct indexing. We'll talk about that in a second. Both of which, to me, are way more effective when it comes to portfolio construction and rebalancing than actively managed mutual funds or trying to do stock picking. So conceptually, it starts with having the right asset allocation in your mix, trying to figure out and the first question is, how much do I want to have in stocks? How much do I want to have in bonds? And so making sure that you're rebalancing to the stock bond mix in your allocation.
Yeah, and just for the audience too, I mean, kind of cookie cutter, but just a general reference point, the typical retiree's portfolio used to be about 60% stock, 40% bonds. What we found over the last several years is that may have changed slightly. So maybe more like 70% stock, 30% bonds.
Right.
I don't want to say that's the answer for everybody, but just for a reference point.
Right. Yeah. Kind of the new normal. People are living longer and longer. Inflation, we haven't seen much in the last 30 years until a few years ago. So yeah, for those reasons, the 70-30 may be the new normal. But this approach still works. If let's say you're all stocks. In a minute, we're going to talk about how to rebalance an all stock portfolio, or maybe you're more conservative than 60-40. Maybe you're 50-50 or 40-60. The fundamentals still remain the same. And so the first piece of analysis is compare your stocks to your bonds. And the example you gave earlier, that 60% in stocks has now shot up to 70 because markets have done well. Well, you're going to be trimming your stocks and bringing them back to 60, and you're going to be redeploying into your bonds. But I want to take it a step further, because inside of those two major asset classes, both stocks and bonds, you're going to dive even further. You're going to have U.S. large, U.S. small, international large and small. We talked about it earlier. On the fixed income side, on the bond side, you're going to have corporate debt. You're going to have government debt. You're going to have international debt as well. And so I think you need to be paying attention to the nuances inside of the portfolio as well.
I love that you bring that up. I show clients that on the daily when I'm just saying, hey, here's your asset allocation, just your relationship between stocks and bonds, but here's what's happening under the hood. And so I always just preface, you're watching the news, or your friends are saying the markets are at an all-time high, they're going to tank, the markets are broken. Yeah, that's fair, but I always point out the large U.S. portion of their portfolio and say, most of the time they're talking about this portion.
That one piece.
Yeah, S&P 500, which is the biggest portion in our portfolio.
And valuations are stretched. I don't disagree with the media, but a well-designed portfolio should have probably 10 solid positions in there, and they all behave differently.
Right. And I just say, now that we have all these different pieces, I mean, this one could be doing really well, this one's doing poorly, and that's where that rebalancing comes in.
Right.
But also in distribution mode, I mean, we've got different areas of the market that we can now target if maybe one's not doing as bad as the other, and not necessarily have to sell when things are down.
Right. Absolutely. And so kind of going back, this is why I like the ETFs or direct indexing much more so than mutual funds, because when you own an ETF, you know exactly what you own. You own, say, the S&P 500. You know exactly the 500 companies in there. Maybe it's the Russell 2. You own the small cap. It's very clear. But when you have mutual funds, those managers could have some style drift. And so you think that you own a U.S. large fund, and maybe you're concentrated in those tech companies that are getting hit right now. Maybe the manager has bought some mid-sized, medium-sized companies. I think it's harder to construct a portfolio, and those managers are oftentimes throwing off capital gains, which is...
I'm glad you went there. I mean, the taxes too. So we're talking rebalancing and just, buying and selling, but we need to be careful in the different types of accounts.
Right.
So with going back to your 60/40 up to 70/30 portfolio, if that's in a taxable investment account, you don't want to just go in there and sell 10% of your gains to go buy the bonds, because now we're looking at either short-term capital gains or long-term capital gains
So you gotta
taxes.
be tax smart about this.
And that's the other thing. Okay, now let's say everything's going right. You are a do-it-yourselfer. You do rebalance, but now the third piece that comes into line, are you paying attention to what taxes that you're throwing off?
And most people aren't.
Exactly. And so so we like to look at, did we do any tax loss harvesting earlier in the year?
So tell the audience what that is.
So the beginning of this year, 2025, the markets were volatile, specifically the S&P 500.
The tariff tantrum.
Yes,
in April.
right. So we were actually selling while these things were down, the S&P portion of the portfolio.
Well, everybody says that you're supposed to buy when it's down. What do you mean you're selling?
So what the magic happens is that you sell one position. Let's just call it the Vanguard S&P 500. And you simultaneously replace it with something different enough. So Vanguard total stock market.
So you participate in the recovery that happens just like it did this year.
And the Vanguard total stock market has all of the S&P 500 in it, so you still are participating, but it tracks a different benchmark.
And it avoids the wash sale rule.
Right.
So it's perfectly legal. Yeah.
And so what that allows you to do is, when the markets were down, is to harvest all these losses, or to build up a bucket of losses that you can use in the future.
Okay.
They can be used for two things. So one, you can reduce your adjusted gross income by $3,000 a year, and or use those losses to offset future gains.
Right.
So now let's go back to the 60% stock portfolio that is now 70% stock and 30% bonds. If we have gains in that portfolio, we can use those losses to offset it and rebalance in a tax-efficient manner.
And the cool thing is you can carry those losses forward for years. So we have clients, we took advantage of this strategy back in 2022 at the last bear market. There's clients that are now using those losses that they carried forward for 3 years. They're rebalancing tax-free right now as the markets have done really well.
Right. And so, I mean, at the beginning of the year, S&P was down. Now it's pretty much up, but now we've been able to realize these losses and still see a positive return in the portfolios.
Right.
So way different story that if people are having those capital gains being thrown off at the end of the year, and if markets are down, and then they still have a tax bill.
And so to be clear, inside of your IRAs, inside of your Roth IRAs, you don't have to worry about the taxes at all because there aren't any. It's sheltered. Where you got to pay really careful attention to the taxes is in your taxable account, your brokerage account, your trust account, individual account.
Yeah, just be careful. Like don't or listen to the podcast and be like, these guys told me to rebalance now, and now I got a tax bill coming my way. You got to see what makes sense for you.
Right. And so the other thing to pay attention to, the next layer, you touched on it earlier, is when you're making the decision to go ahead and sell something, make sure that it's going to be considered this is in your taxable account, a long-term capital gain, which means you've owned it for 12 months and a day. And as long as you've owned it for 12 months and a day, it's long-term, which means it's taxed at the more favorable tax treatment, which is 0%, 15%, or 20%, depending on your income. I think for a lot of folks, they find themselves in the 15% bracket, which tends to be lower than their ordinary income brackets, which are usually higher.
Which brings up another financial planning technique that you could look into is if there's a low income earning year and you find yourself in the 12% tax bracket, or if you're just retiring and find yourself in a low tax bracket, that would be a time to maybe realize some losses at 0% long-term capital gains.
Gains, really. Sell some winners.
Sell some winners, yeah.
So tax gain harvesting.
Yes.
Right? So so what people need to do is, if they're in that 12% bracket like you're talking about, now go over. So on our ordinary income, we've got 7 brackets, a 7-bracket system. But on capital gains, we have that 3-bracket system. So check out if you're ever in a 0% long-term capital gains place. Absolutely, Matt. That's when you do your rebalancing ahead of time, capture those gains, and pay nothing in taxes.
And most people know about tax loss harvesting. They never realize to do the tax gain harvesting.
Gain harvesting.
So two different things sound simple, but it's hard to execute per se. Like, again, taking the emotion out of it. Sometimes you just can't get yourself to pull the trigger.
Right. So I've shared about portfolio construction. ETFs are preferred over mutual funds and certainly over individual stocks. But there's one other nuance that I think really combines sort of the best of all worlds, and that's direct indexing. And I promised I'd touch on it earlier. What I love about direct indexing is, for your taxable accounts specifically, you can build a portfolio so that tracks indexes, so just like ETFs would do. But instead of owning 8 to 10 different ETFs, you can basically take the wrapper off and you can own the individual shares of companies. And what's really cool is it's amazing to me, you don't need to own all 500 companies to track that index really closely. You can own like 200 to 300 of them. The science behind this is incredible. And what that allows you to do is, every year in the S&P, even though it has really good long-term returns, 10% per year, every year about 40% of the companies are down. So you can literally tax loss harvest much more effectively using the direct indexing strategy. And so then you're going to take that same approach. Not only are you tax loss harvesting in the direct indexing, you're comparing your S&P 500 direct index to your EFI or your Russell 2000. And so you're going to take the same approach to rebalancing. Once a year is good. I think this strategy might be a bit complex for the DIYer because you have to really be on your game and be owning a lot of individual companies. But if you're working with an advisor, ask your advisor about direct indexing. In my opinion, it's the future.
Yeah, I mean, you bring up a good point, because if you just had the S&P 500 ETF, I mean, most of those companies could be negative. Your ETF could be positive. And so you can't do any tax loss harvesting, even though the companies you own, or some of them, are down. So
right.
Yeah, that makes sense.
Absolutely. The other thing I think people have to be really careful of. So we've talked about how to do it, when to do it, why to do it. We've talked about some of the nuances. One other thing, including tax consequences, people have to be careful of the cost associated with rebalancing.
Right.
A few years ago, the big custodians made ETFs trade for free, which is great. So another check in the box of why I used to use ETFs. But the mutual funds, some of these things can cost $40-$50 to trade.
And it's buy and sell.
A round trip, right. So you got to pay attention to wherever your money's held or custodied. Find out what they're going to charge you to do the trades.
And if you find yourself in a position where you're in an all mutual fund portfolio, hopefully in your IRA, maybe it makes sense just to rip the Band-Aid off and pay the upfront cost to sell out of it and buy the ETF equivalent, just so going forward you don't have those trading costs.
That's such a good point. I would do that in a heartbeat. If I owned an IRA or a Roth and I had any actively managed mutual funds in there, I'd blow out of them today and I'd replace them with a well-constructed portfolio of ETFs.
A couple of things could happen there. You're getting rid of the trading costs, and the internal expense ratio may go down too. So double savings there.
Well, and that's probably why some people hesitate to rebalance correctly is both the cost to do it and then the tax consequences. So, there's that old saying, don't let the tax tail wag the dog. So you just want to be smart about the way that you're handling your rebalancing.
Definitely.
Yeah. So at the end of the day, I think the most important reason why you want to be doing this is you are managing risk in the portfolio. You're not letting any one portion of your portfolio get to a place where it could take you down or derail your long-term financial plan.
And I think something that people need to keep in mind when they are in a globally diversified portfolio, you mentioned it earlier, but you'll never be in first place and you'll never be in last place out of all those different asset classes. And why that's important is because your neighbor's going to say that they're beating the S&P 500 or their portfolio is doing whatever the number is. But in the long scope of things, it doesn't matter. If you can get those singles and doubles along the way, you're going to be in a better off spot.
Right. And the truth is, we always tell people this, and we're not joking. We say, we're going to give you 1 or 2 reasons a year to not like us. And they're like, what are you talking about? Like, well, there's going to be 1 or 2, sometimes 3, sometimes more positions in your portfolio that you're not happy with the returns. And if you followed the siren song of just chasing the winners and you were heavily invested in the S&P over the last 10 years, you could be in trouble if this AI sell-off gets legs and continues. If you are overly concentrated in that S&P, you could be hurt really bad. We've seen it happen time and time again. But if you've stuck to a disciplined rebalancing process, you've not loaded up on the S&P, but you've done just fine, and you can rest easy at night knowing that your portfolio is well balanced, you're diversified. You're not carrying too much risk in the portfolio.
Yeah, I lean that direction all day.
Yeah. Okay. Well, we hope you found this helpful. If we've touched on anything that just leaves you asking questions, or if you're wondering how to do this better, or if you just simply need guidance to do this or a partner on the journey, get in touch with us. We love what we do, that we do this all day, every day. We love who we get to do it with. And so if you're out there and you need some help, get in touch. We'd love to meet you. If you're doing this on your own, good luck on the journey. check those emotions at the door, revisit your discipline process, make sure you rebalance, because now is the time to do it before it's too late.
And that's the show. Thanks for listening. If you're watching us on YouTube, be sure to give us a like and subscribe. And if you want to watch past episodes, you can find us at navigatingretirement.net.